Hello and welcome to Module 2 of the Stock Market Masterclass, Income Generation Strategies. In the first part of the Income Generation Strategies module, we will look at how you can apply a traditional dividend income strategy using portfolio rotation to maximize the stock portfolio's income potential. In this lesson, you will learn how to interpret dividends and dividend franking. We will learn about dividend yield and how to calculate it. We will learn how to understand the different dividend cycles. And finally, we will learn how to maximize dividend income. An important part of all investment strategies is the capability of an investment to generate an income. In the share market, income is generated by what's known as a dividend. Dividends are a distribution of a percentage of a company's earnings paid to the company's shareholders, and the value of the dividend is determined by the company's board of directors. Although some dividends can be issued as shares in a stock, in Australia, most dividends are issued as cash payments, which are generally distributed twice a year in the form of an interim dividend and a final dividend. Let's talk about the terms that you need to be familiar with regarding the dividend process. Firstly, the dividend declaration date, also known as the announcement date, and refers to the day the company's board of directors announces the next dividend information. Come dividend trading period. This is the trading period between the dividend declaration date and the ex-dividend date. The ex-dividend date. This is the date that the share trades without the value of the next dividend payment factored into the price. An investor must own the shares before this date to receive the dividend. The record date. This is the cut-off date established by the company in order to determine which shareholders are eligible to receive a dividend or distribution. And the payment date. This is the date that the payment is made to all shareholders entitled to the dividend. The requirement to receive a dividend on a share you own is simply to own the share prior to the date it trades ex-dividend. As an example, if BHP is set to trade ex-dividend on the 20th of August, you must own the BHP shares by the close of the market on the 19th of August. When you sell your shares after this date is completely up to you, as you are entitled to the dividend even if you choose to sell the shares on the ex-dividend day. You must be mindful that there is a minimum holding period for franking credits associated with dividends, but more on that later. Let's now talk about franked dividends. There are a few differences in the dividends that are paid to shareholders by the Australian companies compared to other parts of the world. Companies pay dividends that are fully franked, partially franked, or unfranked. Franked dividends have a franking credit attached to them, which represents the amount of tax that has already been paid by the company to the Australian Taxation Office. If a dividend is fully franked, the company has paid the tax on the entire dividend, and the shareholder is entitled to receive a credit for the full amount of tax the company has paid. If the shareholder's top tax rate is less than the company's tax rate, the Australian Taxation Office will refund the difference to the shareholder. The credit is referred to as an imputation credit or franking credit. If a dividend is only partially franked, the shareholder is entitled to receive a credit for the portion of the tax the company paid, and if the dividend is unfranked, there is no shareholder entitlement to any credit, as no tax has been paid by the company. On most platforms, the franking amount is displayed as a percent basis, so a fully franked dividend will appear as 100% franked. And as you can see on the example on the screen, a partially franked dividend will display the percent value that has been taxed. The table you can see on the screen lists the 20 most popular ASX shares and the amount of franking attached to them. Franking credits are an important component of your investment plan because any credits received offset the difference between your top tax rate and the company tax. When choosing which shares you want to invest in, the franked amount of the dividend should be a factor in the decision-making process because the higher the franked percent, the larger the offset will be. It is very important to remember that if your total franking credit entitlement is greater than $5,000, you must continuously hold the share for 45 days, not including the buy and sell date, to be eligible for any franking credits. This can be 45 days prior to the share trading ex-dividend, 45 days after the share trades ex-dividend, or a combination of the days either side of the ex-dividend date, as long as it totals 45 days. Now this is not a consideration if your total franking credit entitlement is under $5,000, where you can hold the share for as little or as long as you wish. Theoretically, you could buy a share the day prior to it trading ex-dividend and sell it the next day to receive the dividend and any associated franking credits. Now let's look at share price implications. So what happens to a share price when the dividend is paid? In a mathematical sense, the share should fall the exact amount of the dividend on the ex-dividend date, but the share market is not a perfect mechanism. In a steady market with low volatility, a share generally falls close to the amount of the dividend on the ex-dividend date. As an example, if the price of Telstra is trading at $4 the day before its ex-dividend date and is due to pay a dividend of 15 cents, you can expect Telstra to be trading at a price around $3.85 at the open on the ex-dividend day. Now when markets are experiencing higher volatility, the opening price could be significantly higher or lower than the dividend amount, and it is not uncommon to see a share fall 1 or 2 times the amount of the dividend, or even recover the entire dividend on the ex-dividend day in very strong markets. All things being equal, where a market is not experiencing higher than normal volatility, shares generally recover most, if not all of their dividend, in 4 to 6 weeks after the ex-dividend date. Let's now talk about dividend yields. The dividend return on a share is often referred to as a dividend yield, and this is simply the calculation of the annual dividend divided by the current share price per share. It is important to remember that dividend yields only use the unfranked portion of the dividend. If you want to know what the dividend yield is, including the franked component, also referred to as a gross-up dividend, you divide the dividend yield by 0.7, as we can see on the screen. This calculation assumes that the company tax rate is 30% and the dividend is 100% franked. For partially franked dividends, the formula changes to account for the franked percent. The easiest way to calculate a partially grossed-up dividend is to divide the dividend in 2 parts, the franked portion and the unfranked portion. As you can see in the example on the screen, the first part is the dividend yield times the unfranked percentage, plus the dividend yield times the franked percentage divided by 0.7. As we can see in the example on the screen, assuming a dividend yield of 4%, if the dividend is only 40% franked, the first part of the calculation multiplies the dividend yield by the unfranked percentage. The second part of the calculation multiplies the dividend yield by the franked percentage, and this figure is divided by 0.7. Calculation 1 and 2 are then simply added together to give you the gross-up dividend yield. Let's now talk about dividend cycles. Companies pay their dividends at different times throughout the year, and there is no standard date that must be adhered to. There are generally 4 main dividend payment cycles that most Australian companies fall into, and these are based around reporting seasons. It is a requirement for all companies listed on the ASX to report financial results to the public a minimum of 2 times a year prior to the end of their balance sheet date. Most companies operate within the standard Australian financial year and have a balance sheet date of 30 June, but there are some companies that operate under a calendar year schedule. The best place to locate the scheduled releases of earnings reports are at each company's website. The first cycle of the year starts in February and runs through to late March. The companies that trade ex-dividend in this period will pay their final dividend around 6 months later in the third cycle that runs between August and September. These are generally the companies that operate with a balance sheet date of 30 June. The second cycle starts in mid-April and runs through to the end of June. The companies that trade ex-dividend in this cycle will pay their final dividend in the 4th cycle of the year, and that commences late October and runs through to the end of December. The table that we can see on the screen shows the ex-dividend dates of 2018 of some of Australia's largest companies and the cycles they fall into. Although companies don't report on the exact date from year to year, they are generally around the same time and fall into the same cycle. As you can see in the example, companies from the same sector can report on a calendar year or financial year schedule, so there is no standard mandate for the release of financial results and payment of dividends. Let's now look at maximizing dividend income. As I mentioned earlier in the section, most Australian companies pay their dividends to the shareholders twice a year in the form of an interim and final dividend. Most retail investors hold the shares they own for the entire period in between these dividends and are exposed to the fluctuations of that share for that period, which may result in either a capital gain or a capital loss. Now we'll look at portfolio rotation. Because companies don't all report at the same time of the year, it gives investors an opportunity to rotate the shares within their portfolios to capture more than 2 standard dividends in a one-year period. As an example, a standard investment technique is to own the shares and capture the interim and the final dividend in a financial year. By rotating the shares inside the portfolio, an investor is able to capture multiple interim and final dividends from different companies by selling down the shares once a dividend is paid and purchasing shares in a different dividend cycle with proceeds. The example that we can see on the screen demonstrates how this strategy can work by holding positions long enough to receive the franking benefits and still capturing 4 dividends in a year. For the sake of this example, we have used one position. This in no way represents a portfolio that is diversified, but it is designed to demonstrate how the rotation works. As you can see in the example, the shares are held for more than a month after they pay their dividend, which all things equal gives the share a chance to recover to around the price it was prior to trading ex-dividend or greater. The example also demonstrates how it is possible to purchase a share during the dividend trading period to capitalise on any positive movement if the share runs higher prior to the ex-dividend date, with each purchase occurring around 2 weeks prior to the share trading ex-dividend. There are 2 major advantages when applying this strategy. Firstly, an investor has the opportunity to capture 4 dividend payments for the same invested capital per year instead of the standard 2 dividends, with all of the franking benefits when the shares are rotated correctly. And secondly, this strategy gives an investor an opportunity to achieve better than the standard dividend income, regardless of what the share market is doing, as dividend income is regular and rarely fluctuates like the market can. As with any strategy, there is a trade-off where capital gains may be missed in a share while an investor is rotating between the dividend periods. The flip side is that potential market downturns may also be avoided, as this strategy does not require full-time investment in the markets. In this lesson, we have learned how to interpret dividends and franking credits. We learned what a dividend yield is and how to calculate it. We learned about the different dividend cycles. And finally, we learned how to maximize dividend income. This concludes section 1 of the Stock Market Masterclass, Income Generation Strategies. In the next section, we will learn about combining growth and income strategies and how to apply both long-term and short-term strategies in the same portfolio.